Well, greetings and salutations, Series 9 test takers. This is Dean Tenney coming to you from my studio here in fabulous Las Vegas with an explication of a Series 9 practice test. The best free supplement to your paid study materials is my YouTube channel. But if you don't have a Kaplan Q Bank, that would be a great paid supplement if you don't already have it in your possession. I recommend that in the quick sheets. With my Series 10 or Guru 10 discount code at checkout, you can bring in a Kaplan Series 9 Q Bank for about $55 or so. So for that commercial, Kaplan allows me to give you a free look on Kaplan content. So let's get going on this thing. The U.S. Patriot Act. Now, what you should do in case you're a new follower to the channel is hit pause, answer, hit play, see how your answer compares to mine. We'll see, at the end if I miss any. If you disagree, wait till the end and we'll see how I do. All right, so that's kind of the game plan. It gives you another way to take an intellectual inventory before your Series 9. The U.S. Patriot Act requires broker-dealers to verify and properly identify specific information for each customer. The information that requires verification includes all the following except a tax ID number of some sort, yes. Customer name, address, certainly. Date of birth and a picture ID, very testable on that picture ID. It doesn't require employment and marital status. So D is in dog. Question 2, which of the following statements regarding an option sales ledger piece to be sent to 15 of the firm's retail options customer is true? The piece is considered retail communication. No, retail communication would be more than 25 prospects or clients in a 30-day period. So that's not true. Advance approval by the SEC, should have been able to toss that out pretty quickly. You should have been able to toss out advance approval. I mean, I think you should flunk the 9 immediately if you even think that SEC and FINRA approve anything. The two nasty words in the securities industry are the word approve and guarantee. We shouldn't be saying anything's ever approved, and we should never use the word guarantee. So however you get there by process of elimination, D is in dog, D is in dog. Question 3, standard equity option contracts must be aggregated for all the following except. Yeah, European contracts are a little funky. They don't need to be aggregated. A. Question 4, regulations show that's a locate requirement for short sales. And we need a locate identifier for that. We need B. Question 5, a cancel rebill may occur for various reasons, which include all the following except moving a position from a cash account to a margin account, certainly. By the way, as a Series 9 sales supervisor, you're going to be, suspicious of cancel and rebills. You just might want to make sure there's no shenanigans going on. Entering a trade into the incorrect account, indeed. Sending out a confirmation with an incorrect price, indeed. Those all sound like operational back office support unit stuff. D, incorrect level approval of options, no. So D is in dog, D is in dog. Question 6, a firm offering portfolio margin must approve the account for uncovered option writing. Well, however you want to think about that. I mean, you have to be approved to do that. You got to have portfolio margin, but A is certainly true. B, apply to and receive approval from the designated examining authority to offer these type of accounts. Yes. Once we have A and B, we know it's got to be all of these, which means D becomes free information. D, ensure customers must receive and acknowledge in written form a rating, a risk disclosure statement. Yes. And then what they're going to get is dynamic margin and more time to meet maintenance calls. So it is C, all of these, all of these. Question 7, all the following positions have limited loss except. Definitely should expect a question about this as a supervisor to be able to recognize things that do or don't subject customers to unlimited risk. Long the stock and long the put is a pretty smart thing to do. There, your loss is limited to whatever you're out of pocket for the stock and the protection, break even to the strike. Doesn't have unlimited loss potential. Short the stock and long call, there's a smart bear. I have no problem. There's a smart bear. Don't be a dumb bear. Right here, we have a choice to buy back the borrowed stock at the strike price, and therefore we do not have unlimited risk. That is an effective hedge. C, short the stock and short the put. I hate this, but it's one of my pet peeves that, I don't even know why we bring this up as a potential strategy, because why would you want to not effectively hedge a short stock position? You don't need an obligation to buy back the borrowed stock. You need a choice to buy back the borrowed stock. I always think people kind of have this ass backwards. I'm not going to require you to put up margin for the short put, so what? I mean, you still have unlimited loss potential. C. Long the stock and short the call. Covered calls do not expose customer unlimited risk. It is break even to zero. Question 8. All the following are true regarding an option sales piece prepared by a registered rep, except registered rep may never guarantee a profit. That's a layup. Yes, that's true. I'm looking for something that is not true, something false. A registered rep may never use a professional designation or degree in a sales piece. I mean, they can, as long as it's appropriate and it's germane. So that is false. A registered rep may never communicate that options are suitable for all investors. That's true. A registered rep may never guarantee. So the answer is B as in boy. B as in boy. Question 9, your customer who has a history of placing only call orders mistakenly buys a put option instead of a call option through the broker-dealer's website. The firm decides to accommodate the customer. The position has since moved away from the original market. As a registered rep, what would you do? Now, we always want to have a supervisory outlook or control over that error account, but that's what we're going to do. We're going to move the order into the firm's error account. Again, if there's shenanigans, we're kind of on the lookout for cancels and rebills, the error account. No shenanigans here, but that's what the error account is all about, right? Question 10, an investor enters an order to buy one MCS July 60 put at 11, sell one MCS July 50 put at 3. A couple things here I would comment on. A lot of times I think Series 9s make a mistake in thinking that this is going to be, a bunch of questions on option strategies. They're there, but, make sure you pay attention to the stuff on the 9 that isn't option strategy. Second point, we love spreads as supervisors because all the action takes place between the strikes. All the action in this, for example, takes place between 50 and 60. And that means the gains and loss add up to 10. As a supervisor, I kind of like that limited loss potential of the spread. I particularly like credit spreads because a credit spread is where I'm going to make that margin requirement go away. I'll probably link to my advanced option strategy lecture so you can, if you need to review strategies, you can do so. There's also some stuff in the 4 playlist. Anyways, this customer paid, this is my pet peeve, by the way. This customer paid 11 points for the put and only brought in 3 points for the 50 put. This is a debit spread. Now, what I don't like about it is a debit of 8, right? And a gain of 2, which, I don't think is a very good risk reward trade-off, but, proof who people who write Series 9 practice questions don't trade options. But anyways, it is a debit spread and the dominant leg is the 60 put. And so I'm hoping that this thing will go down, right? So it's a debit spread, anticipation that the stock will fall. Boom. Question 11, which of the following orders can be executed on the opening rotation? Yeah, it would be market orders, right? Question 12, a customer with a margin account has a current market value, the securities, I prefer that would say a debit, but it's, debit registered debit balance, but a debt, the margin loan tells you that on which he pays interest. The equity, the difference between the market value and loan balance. The approved method for keeping the running values of the portfolio is referred to. That's called mark to market, right? And remember, that's going to be the minimum maintenance on an option is going to be, if it's naked or uncovered, right, is going to be 10% of the market value, which is changing all the time. And the current premium kind of makes sense because with the current premium, we can do the offsetting transaction. We can do a closing purchase at that price. Anyways, the answer is C. Question 13, an investor has a diversified portfolio of common stocks. So I'm worried about systematic risk here, not selection risk, and has a beta market value of 1.7 and a beta of 1.2. If the OEX S&P 100 is currently quoted at 680 to protect the portfolio against a decline in value, the investor's best strategy is you should have been able to look at this pretty quickly and have a 50-50 and know it's either choice A or choice B, because the way we hedge a long position is with puts. So that alone gives you a 50-50. Now, I'm hoping you're operating from abundance and you can just, guess B and assign this in universe if you choose to. But the way we would do that is divide the portfolio value 1.7 by the market value index, which is 68,000. And then we would multiply the result by the beta 1.2, and that would give us the 30 contracts that are necessary. I could have just guessed B. Ooh. Question 14, recommendations to a customer to purchase or sale any option contract can only be made if reasonable grounds for believing the recommendation is suitable for that customer has been attained based on the information furnished by the customer after reasonable inquiry regarding the objectives, financial situation, and needs. The suitability standard is applicable to here, what this question is about in the answer set is making sure you understand that general securities principles are not series fours, right? So the person who would determine suitability would be the registered trading permit holders, the registered option principal, and registered rep. The other people, by the way, if there's any one thing in the answer that's wrong, it makes the whole answer wrong. So the answer is B, right? General securities principles are not registered option principles. Question 15, all the following option strategies could be effectively used in a bear market except a short call, yes. A short straddle, no, if you were bearish, you wouldn't be doing a short straddle. You just, short go long the put or short the call. A debit put spread is bearish, yes. And a credit call spread is very good idea, right? As a supervisor, you love D as compared to A. I mean, anybody who would want to write a naked call and pick up nickels in front of a bulldozer doesn't mean it means they don't understand about a credit call spread, right? So as I said, as supervisor, we love spreads. I might even call you and say, really, you want to short a call? Why do you want to be a dumb bear? Why don't you be a smart bear? Take some of your money, buy a higher strike call just in case. That way you have limited loss. P.S. All you would have to leave in the accounts is the difference in the strikes. If you want that at a short call, I'm going to ask you for 20% of the market value plus the current premium, less the out of the money amount. So we're a big fan of not doing A and a big fan of doing D instead. The answer is short straddles are neither bullish nor bearish. Which of the following is an advantage associated with writing covered calls? The biggest thing as a supervisor, sales supervisor 9, is that the customer doesn't participate past the strike price, right? So there's a ceiling of whatever that strike is. Protection against a rise in the stock price. Some protection against the downside on a long stock. Yeah, we're lowering our out-of-pocket cost, and so we do get some price decline protection. Now, the price decline protection is the premium we receive. You don't typically do a covered call because of the partial hedge, but that is indeed true. You do covered calls to generate additional income, right? Customer has 3 sources of profit, the difference between the stock and the strike, the premium, and any dividends along the way. So we're big fans of covered call as long as the customer understands that they don't participate past the strike price. All right, let's see. The premium received from the call raises the break even. No, it reduces the break even. Complete protection against the downside. No. You don't get complete protection. You're still going to fall down, ever many flights of stairs. For example, if I buy the Apple at 142 and write a 145 call for 4, 138 is my break even. I fall from 138 all the way to 0 instead of 142. That's still painful. That's still painful. So the answer is B. Question 17, an associated person is involved in a car crash. When the police arrive, they give the associated person a breathalyzer test, which the associated person fails. The AP is later charged with felony DUI and will have a 1-year suspended license. As the trial date approaches, the charge is reduced to a misdemeanor DUI. In this situation, we notify offender promptly no later than 30 days. So this is indeed a reportable event. So boom, A. A California branch manager leaves for a week of vacation, question 18. Which statement regarding options transactions during the manager's absence is true? I think this is getting about delegation. The vacation manager must be available to electronically approve any new accounts or transactions. That sounds unreasonable. No new option accounts may be opened. No. The firm may have a registered option principal review the options trading activity from another officer. Yeah, that sounds pretty reasonable. New option trading must cease. No, you can get that right with what I call reduction to the ridiculous. What does the world look like if that's actually the answer, right? So, and if it can't sustain reducing it to the ridiculous, then it's probably not a good answer. Question 19, an error account may be used for all the following except. To hold a position, you are going to get, test on the error account. Again, we want to make sure there's no shenanigans going on with the error account. To hold a position inaccurately executed for a retail customer until close, yes. To hold a position until liability is determined for the erroneous transaction, who's going to be held accountable, certainly. To house a position inaccurately assigned to a retail customer, absolutely. To offset, hedge, or flatten a position in the proprietary trading account, no. As I said, that wouldn't be potential shenanigans to be using the error account to, have anything to do with our market making or proprietary trading. So the answer is D. Question 20, the two option contracts in a straddle have all the following except. Yeah, I kind of like this. This is testing on nomenclature or vocabulary, right? And there's two different type of contracts in a straddle. There's a call and a put. You're either long two different type of contracts or short two different type of contracts, right? So I kind of like this one. I mean, other than that, it's going to be, standard. It's going to be, long 10 Apple, February 140 calls, long 10 Apple, February 140 puts. And we're either buying or selling non-directional volatility. Question 21, a firm has received prior approval to use first in, first out as his option assignment method. Remember, we're going to do random 5-4, another fair method. And remember, whatever we're doing, we have to inform the OCC and we have to inform our customers and do the same if we change that. Under what circumstances may the firm revert to a random selection basis? So, the point here is we better not be doing this on a discriminatory basis. We're changing to, protect one of our customers, for example. A, with the written approval of the ROP only, no filings with, no, that's not true, right? I just said you got to tell everybody if you're going to change it. So if the change has been reported to and approved by the exchange or SRO to which the firm reports, and after customer notification, that is indeed correct. I would expect you could see something like this, similar to this on your Series 9 as well. And then remember the OCC itself, the Options Clearing Corporation, does it on a random basis, Question 22, the new account form must be signed by, yeah, I would definitely know this, right? Registered option principal or Series 9, 10. So A. Question 23, in a cash account, a customer buys 300 shares at 48. So 300 shares at 48 is 14.4. Remember, it's a cash account. We write 3 XYZ January 50 calls at 1. Pay attention, and this is the only time I can do an opening sale in a cash account. All short sales must be conducted in a margin account. The exception is a covered call. So I'm going to bring in $300 for the calls. And so the margin requirement is 14.4. The margin call is the difference between the margin requirement and what I need to deposit, right? The deposit is the margin call. So as a margin clerk, I'm going to say we need 14.4. There's 300 that already in your account. So please send us $14,100. Now, if that was a margin account, it would be half of the 14.4. And then we could, we use the 300 like we did here. I would know that we're not going to allow you to do opening sales without a margin account unless it's an opening sale on call contracts on stock that you own. Otherwise, you're going to have to open a margin account. So this is the only time you can do a opening sale and on an option and not have a margin account. Question 24. Which of the following options a customer holds must be aggregated to calculate position limits? What that means in plain English is the position limits apply to the same side of the market, and they apply to the class. That would be XYZ calls is a class. XYZ puts is a class. So here they're asking, first thing I got to figure out is what is the same side of the market here? Well, being long the calls and short the puts, right? The long calls are a choice to buy the stock, and the short XYZ puts are an obligation to buy the stock. And so that would be aggregated to be 14 contracts on the same side of the market. So I even know the same side of the market is long calls and short puts. That's the bullish or buy side. The sell side would be short calls and long puts. But as you see here, the short XYZ call there is on the opposite side of the market. And then the puts are not on XYZ, they're on LMN. And so the answer is 1 and 4. I would have a general understanding of position limits are. Usually, by the way, when they do this on the exam, they say assuming position limits are. And then they, give you the position, and then you have to aggregate it based on the same side of the market. The other thing I would tell you on the exam is sometimes they say a husband and wife acting in concert. So whenever you're on the exam on the 9, you're acting in concert. That means the people in the question are to be considered one party for purposes of whatever rule discussing, right? Husbands and wives are always considered to be acting in concert. I joke, if they're not, then what's the point of getting married, right? Yeah, the record keeping and customer identification program is about the Patriot Act and money laundering. So it's one of the few records that is not lifetime 6 or 3. The vast majority of brokerage firm records are 3. This happens to be one of the funky ones that's 5, right? And customer complaints are 4. That's kind of the other funky one. So this is, again, the customer identification program is, to make sure you are who you claim to be, and where we get a picture ID. And then our WSPs, we have procedures for closing accounts in which we aren't able to identify. An investor who's entered into a credit puts bet will profit. So, we established the net credit, right? So we need it to get smaller. We need to be able to do the offsetting transaction for a smaller difference. What we mean by that is we need the difference in the premiums, that's the spread, to narrow. So, by the way, as we said, the main thing here is we, as supervisors, love credit spreads, because the alternative of this would be have the customer to short the put, right? If he just shorts the put, he's got an obligation to buy the stock. We might be interested in cash equal to the aggregate exercise price. But if I tell the customer, why don't you buy a lower strike put just in case somebody sticks it to you, you can stick it to the next guy, then, we're going to reduce dramatically the potential loss, and the margin call will be substantially less as well. So here it's about it'll profit if the spread narrows. But, the key as a supervisor is not so much that as that I love credit spreads as a supervisor. Question 27, a stock locate identifies. So remember, we have a locate requirement before going short. And it identifies the clearing firm or broker dealer that is lending us our stock for that short sale. Question 28. An investor buys one MCS July 35, call it 8, when the market price is 36. Who cares? The stock subsequently moves to 41. The investor exercises the call contract. For the most part, cost basis follows break even. There's exceptions to that, particularly like a covered call. Wouldn't overdose on the tax consequences of this. But yeah, the cost base in my MCS stock is 38. It's my break even, right? And for the most part, that's how cost basis follows break even. For the most part, what I'm saying is if you, for probably what, I don't know, 8 to 10 times on the test, if I ask you cost basis and you do break even, you would be correct. Usually on the test, they don't use the word synthetic. They say most similar to, and even if that's not the case, that's how you should approach it as a test taker. I have a video in the Series 9 playlist on synthetic options. I'll probably redo it. The channel's coming up on its 2-year anniversary. One of the reasons I'm putting this into the playlist for you 9s and 10s and 24s, and people have matriculated through the channel using our free supplement. And, I'm trying to beef up our content for you folks, even though there's not as many of you, right? So, there's a lot more views in the SIE channel, for example. Anyways, a customer had no previous equity or option position wanted to put on a synthetic short call. So what I would think about is why would you want to do that first? But, a short call, remember, has limited reward and unlimited risk. Limited reward and unlimited risk. So I've sold 10 puts to open. So that does not have unlimited risk. Remember, the unlimited risk would be if the stock goes up. So again, that's how I say as a test taker, I would approach this. I would approach this by saying, okay, I'm looking for something that has the same risk reward kind of parameters as does a short call. So I think if we sell short the stock, right, then we would have that same risk reward, right? Limited, we would have limited reward, non-limited risk. So I think you'll get at least one synthetic question, maybe 2. So I would be prepared for that. Question 30. The primary purpose of the opening rotation is to establish the opening prices for options, right? An order management system has internal controls which can restrict access, right? I mean, that's what the control word means, is that. A customer buys one January 50 call at 5 and writes 2 XYZ January 55 calls at 2. If XYZ were to rise to 64 and all the contracts were exercised, the customer would have a loss of. Now, again, I am a big fan of using a T to track monies in and out on option strategies. And so what I would have done here is say, okay, well, I bought a 50 call at 5. So I'm going to put that there. That's going to be my dollars out. And let me get a smaller font for that. And let me change that. So there's my, well, I got a lot of stuff going on. I also want to label it, kind of keep track of what's going on. So there's my 50 call. And then I write 2 January 55 calls. So 2, and these are 55 calls. And I'm going to go ahead and put the entire amount in there. So remember, that's 2 times 2, that's 400. So that's going to be 4 points there. When you got a lot of things going on, you might want to, I'm just going to put the zeros in there just so when I close this thing out. And here, this is going to be 400. And we'll put that in green because remember, that's the money we're bringing in. Okay, and now it says, if it were rise to 64 and all the contracts were exercised. Okay, so what that means now is on my 50 calls, I'm going to buy the stock at 50. And I'm going to sell at 64. Let me put that in the whole thing. So that's going to be 5,000. And again, I'll put that in red because we're buying that. And let's see, close, it says, and contracts were exercised. So now that means the those 2 calls, those 55 calls, I'm going to have to sell the stock at 10.5, right? That's going to be, I'm going to get exercised. I'm going to have to go buy the stock at 64. And let's see, so 64 is going to be 200 shares there. That's going to be, well, let me a calculator here. By the way, you might want to just give yourself permission to guess B on this. So times 2, that's 12.8. And then remember, I'm going to sell it. And I'm going to sell it for 55. So that's going to be 5,500 times 2. That's going to be 11,000. And then we've got our calls that we got here, and that's 6,400 there, right? Because I bought it at 50 and I sold it at 64. So when I net out all those columns, it looks like I'm going to have $500 more out than in. So I think I got that right. But if you have a QID number, or if you want me to rationalize, just give me the QID number. I'm more than happy to put in the video description a better flow of the dollars out and in. By the way, I would tell you as a test taker, I suggest using the T and not trying to memorize a bunch of stuff. But however you get there, need to get there. Let me clean up my slide. Boom. And you have plenty of time. I mean, that took a little time, but you got plenty of time to do that. Which of the question 33, which of the following words would likely appear in a lexicon-based search? All right, so that means you're going to put in a word, and when that word pops up, it would flag it as like a potential email to look at it. And it's certainly the words here that we would want to make sure reps aren't using are the word guarantee or refund. So on December 1st, a customer emailed an associated person of your firm bitterly complaining that a recent recommendation was not in line. The associated person was out of the office for a few days and read the email on December 4th after returning to the office. When should they send that to FINRA? So remember, it's based on the end of the quarter, so the end of the 4th quarter. And so it'd be 15 days after that. So it'd be January 15th. Now we would do it. There's a more sense of urgency there, the complaint is about fraud or something like that, then we would do it immediately. But it's 15 days after the end of the calendar quarter. Which of the following statements regarding the documentation is required for new option is true? Question 35. The date that we gave them the OCC disclosure document, certainly. The employment status is not required. Which of the following statements regarding the document is true? 2 is not true. Got to be careful on the grammar. So the level of trading approval must be included. Absolutely. The customer signature is required. No, it is 1 and 3. 1 and 3. Question 36. All the following must be completed before a customer enters his first option trade, except, boy, these except questions are, problematic. Delivery of the OCC disclosure document. That is true. We're being asked to accept. Completion of the new account form. That is true. Approval by the ROP. That's true. Now, remember, the signed option agreement is within 15 days of the account approval. I would definitely know it's 15 days of the account approval. And then remember, if it's late, we're only going to allow the customer offsetting transactions. Very testable, very testable. So remember, that gives them 15 days to read the booklet, because the booklet is 100 plus pages and all the bad things that can happen. If an OEX question 37 375 call is purchased at 3.25 and is exercised when the S&P closes at 381. So you need to know index, settle, and cash, and the cash is T+1. Both the option contract, the index option contract, and the settlement are both T+1. And what the person who wrote this thing owes is the intrinsic value. So the intrinsic value of the 375 call with it at 381 is 6 points or $600. So the writer is going to deliver $600. Nobody would play with you if you had to deliver, 100 shares of 100 stocks, right? So we just agree the way you're going to settle up is that intrinsic value. Not testable, but the guy here made some money, right? So he paid $325, he received $600, but that wasn't what this question was about. Question 38. Market makers on the CBOE floor may deal with all the following except they do not deal with public customers. B. For the purpose of calculating position and exercise limits, which of the following is true? Standard contracts are aggregated for both mini and jumbo contracts. That is indeed true. So the answer is A. Sorry about that. I had to take a little check an email there real quick. I'll try and learn how to splice it so you don't have to watch Dean returning stuff. I'm getting better at editing. Anyways, a customer shorts 100 shares at 30. Subsequently, the stock drops to 25. So far, so good. At this point, the customer feels there's an equal chance that XYZ may again to begin rise steeply. So I'm afraid the market is going to move against me. And these circumstances, what should I consider doing? I consider perhaps buying the call to protect the short stock position. I don't typically like the numbers here. I would like the numbers to be even more attractive, but remember, boom. As a Series 9, we love people who buy calls on short stock positions because it changes the short stock position from unlimited risk to limited risk. So I might even reach out to you as a sales supervisor and say, hey, why don't you buy a call just in case you're wrong? So we love long calls on short stock positions. As I said, don't be a dumb bear, be a smart bear. And somebody who's short the stock and is long a call is a smart bear. Brokers or other individuals who exercise discretion over customer accounts, question 41, are trading with other people's cash and securities. When exercising discretion, it is easy to do things that you might not do in your own account. For this reason, there's a heightened review of all trading activity in discretionary accounts. The primary issue is all of these. Well, we don't know what all these would be. Risk tolerance threshold of the customer, the options level on the trading activity for which the customer is approved. Yeah, I think what we're going to be concerned about in heightened suitability is heightened supervision is suitability and turnover activity, right? Question 42. The customer option agreement includes a statement that the customer must notify the firm if there's any material financial or marital changes. Yeah, boom, aim and shoot, point and click. CBOE, no. Yeah, I mean, that was an aim and shoot, point and click one. Question 43. When is the absolutely latest that an options disclosure document can be delivered to the customer? It's at the time the account is approved for option trading. So don't, let them bait you into some, answer just because of the phraseology. So the answer is C. Once the circuit breaker 44 has been triggered in a stock, Regulation 201 will impose a restriction on prices which can be sold short, meaning it's got to be a better than the inside bid, the highest bid. Using the following information, what price would violate the rule? Well, I said you got to be at better than the best, the inside bid, which is 3270. So 3270 itself would be a violation. It's got to be better. It's kind of like a modified version of an uptick rule, basically. I think we saw one like this previously, 45. Any sensitive word captured in the lexicon-based search where I put it in, what should I do with those? It should be highlighted for immediate review, right? Because then we're going to go back and find the actual email itself and see what was said or said in that. Maybe we'll find it's innocuous and it's just in the normal course of a conversation, or it might be something that deserves some more follow-up. Question 46. The number of components in a narrow-based index must be fewer than, boom, 10. Question 47. In a new margin account, the customer buys 300 shares of 48. I think we saw this before. I think last time we encountered this, it was a cash account. And this time it is a margin account. So 300 shares times 48 is 14.4. We did that math before, right? But now, since it's a margin account, you only have to put up half that, and we will loan you the balance. So half of that's going to be 7,200, right? So that's the margin requirement. Now be careful. If they asked us the margin call, that'd be the difference between the 7,200 and what we brought in. And what we brought in here, remember, is the 3 times 150, the 450. So the margin call would have been answer D. It didn't ask us the margin call. It asked us the margin requirement. There is no margin requirement on the short call if you're long the stock, right? So there's no margin requirement. And then I said the other thing here is that you don't need a margin account to write calls on stock that you own, right? So 7,200. 48, the position limit for some large capitalized and active securities is 250,000 contracts on the one side or same side of the market in options class. Remember, that was the type plus the stock. The equivalent stock position would be, well, we're going to take, remember, each contract governs 100 shares. So we would take the 250,000 contracts times 100, and that would give us the answer, which is 25 million. I would expect to have to do practical application on position limits. As I said, based on debrief, something like assuming position limits are, and then ask you to, find the one that would be a violation of that, those position limits. It makes sense. We don't want the tail wagging the dog. We don't want the options market driving the stock market. So it's to prevent market manipulation. It's also prevent the derivatives from driving the stock market. Question 49, direct access can cause errors to be instantaneous. Which of these errors would appear instantaneously due to direct access? Adding an extra 0 or 2 to the quantity, we call that a fat finger trade. Yes. Trading the wrong symbol by mistyping, another fat finger. So A, B is true, so that means it's all those. Buy instead of selling. Yep. C. Question 50, which of the following recording requirements is not correct? Not correct. The CIP records are kept for 5 years. That is indeed correct. We talked about that earlier in a question. B, error reports, trade corrections, customer order tickets are to be kept 3 years. We talked about that earlier. The vast majority of brokerage firm records are 3 years, so B is correct. The articles of incorporation or corporate charter of a broker-dealer or life records. Yes, that is 2 correct. So leaving us choice D. Any changed account forms, those are usually going to be kept 6, not 3. So the answer is D, is in dog. After the identity verification of each customer, the member firm must check. I would definitely know this, the Office of Foreign Asset and Control, to make sure that this isn't some restricted national, right? Somebody who's under sanctions, for example. So the answer is D, OFAC. Exchange routing systems are all different, but they all perform the same function. The systems provide direct access for customers only. No, but they all prefer the same. All of these, we don't know till we reach them. Well, if we said no to A, it's probably not going to be that. Require market makers to show double-sided markets. The systems do not have a minimum size or price. There we go, D. So that's how they're different. D is in dog. A retired customer wishes to open an option account. The new account form states the customer objective is income only. The account could be approved. I like this. Remember, that's what covered call writing is all about. Covered call writing is about generating additional income. So A sounds pretty reasonable. The account could be approved, under no circumstances. Again, you could use reduction to the ridiculous. All types, no. Option purchase. Purchases means you're confused. Income means we're selling an option. So the answer is A. The risk of direct access can partially be offset by the SEC requirement to establish a system of risk management and supervisory procedures, right? So we're allowing our customers not to come through us to have direct access to, executing orders. So that's true. Maintain a system of risk management and supervisory procedures. Certainly. I mean, that sounds reasonable. Document a system of risk management. Yeah. So yeah, all of these. Question 55. Firms must determine the best market for a security so they may buy or sell the security in such a way that the resulting price to the customer is as favorable as possible under prevailing market conditions. That is called best execution. Best execution doesn't necessarily mean the best price. It's a combination of all those factors. It's only the capacity of principal for retail customers? No. It's either agent or acting as a principal for all customers. Yeah, capacity. Doesn't matter what capacity we're acting in. That's going to be true. As an agent or principal, institutional customers are capable of protecting their own assets. So it's always about protecting retail clients. Joe Sixpack. So the answer is B. All right, so let's see how we did. No surprise, I teach the Series 9, and so I'm very familiar with the Series 9 QBank. Hope you found that helpful. If you have any QID number you'd like me to further explain, either in the video description or to you personally in a video or on the website, please just let me know. And like I said, I thank you for all your referrals. Now, if you're doing this 9, you find it helpful, let me know in the comments, because I'm not going to do the 10 until somebody in the 9 says they're on their way to the 10 and they found this useful, and would I do it for the 10? And so if you see a 10 already there, that means somebody has already told me that they'd like me to do that. Again, thank you for all your referrals to your SIEs and your 7s and your 66s to my supplement, my free supplement, the YouTube channel. Remember, inch by inch, your Series 9 is a cinch, and yard by yard, your Series 9 is hard. And I will see you for the next time I see you in the Series 9 playlist. Bye-bye.